Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 28th August 2026, and joining Derek to pose some questions on the financial market themes for the week ahead is Simon Mays, Head of UK, Ireland and Swiss FX Corporate Sales. This material is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hey, Derek, happy Friday. And the same to you, Simon. How are you?
I'm very well, thank you.
Good.
I think best place to start is probably going to be Jackson Hole. Seems like we've been waiting for it all week.
Yeah.
It's the big focus this week. Always a lot of focus on Jackson Hole, but most of the time it doesn't really have too much impact. There are a couple of notable times in the past when it has. How did you view Warsh's speech this time round from a surprise perspective?
Well, I think the first point I'd make is going into the speech, the pricing for a hike in September was just 9 basis points, 8 to 9 basis points. So my feeling going into the speech was that was a little bit on the low side, just because, the inflation data alone is still pretty elevated. The core PCE at 3.3%. So in that sense, we've had the kind of reaction that you'd expect. His wording on inflation is, again, given where inflation is at the moment, is not hugely surprising. But, we have work to do if inflation not moving to 2% with speed. And I think it's the with speed that may kind of spook the markets in terms of reconsidering September, because you certainly can't say it's moving with speed towards target. Also said, hard pressed to say financial conditions are restrictive, and inflation data doesn't suggest trend meaningfully improved. So, you're talking about, in their view, an economy that's at full employment. You're talking about an economy where inflation is above target and not coming down. And you have financial conditions that aren't restrictive. In any normal-ish world, the market would very quickly be priced for a hike on the 16th of September. So I wouldn't be surprised if we see a continued gradual grind in that direction, given we're still only around 50-50. Now, I think the reason why we're only at 50-50 is obviously you've got a payroll support, you've got another set of CPI figures before the FOMC meeting. So, the holdouts will point to those data points. And while I can understand that to a degree, you could also easily argue that if you did get a surprise downside move in the CPI data, it would probably need to be backed up by a pretty weak payrolls. And even then, you'll have some saying, well, that's just one data point. And the bigger picture is inflation is still sticky, it's still above target. So certainly based on today's comments, and of course, we've come in with the market still reacting as we speak, but it does look like there's the scope there for at least the market to move up its pricing in terms of the probability of a hike in September. And in that context, obviously, the dollar move is understandable. Yeah. I think short term we can definitely see some further move to the upside.
Yeah, on that point, I guess dollar debasement has been the buzzwords, if you like, for a little while. It's been the big story up until Jackson Hole seems to have faded. So yeah, any thoughts on that?
Yeah, again, we've done some analysis where we've kind of picked out episodes of dollar debasement being a theme, and we've pulled out periods of we've looked at data back since 2015, and based on averages and then Z scores, we've picked out extreme moves, sudden moves for the dollar weaker, gold higher, and then looked at what happens at treasury yields. And what comes back is that basically dollar debasement episodes tend to be quite fleeting, especially if rates go up.
Yeah.
Now, if rates move to the downside, then that dollar debasement theme can extend and you can get bigger dollar moves. But of course, if rates are going down, then dollar debasement isn't purely there in evidence, and it's maybe become something more cyclical as well. So I'm not too surprised that the debasement kind of focus has been fleeting. Rates have gone up, and then even if you look at what's behind the move up in real yields, the whole debate about term premium, is it fiscal risks? If you look at sovereign spreads over OAS swap rates, it doesn't look like there's been any deterioration in fiscal risks into the buyback announcement. Inflation expectations are relatively stable. So it looks more like it's AI related, capital demand. And in that sense, again, that's not the recipe for a sustained dollar depreciation. So after Warsh's speech, if you look back to the buyback announcement on the 19th, the DXY high in the day was, I think, 99.70, 99.75. We're trading 99.50 now. I think we can obviously get back up to those levels from when the buyback announcement was made. And then I think, we can certainly grind up to the 100 level on DXY.
And then what do you think that might mean for dollar yen? Obviously, there's been a lot of focus on dollar yen this year. We had Himino speaking earlier in the week. Do you have any thoughts on that speech and the levels of intervention that have been confirmed between July and August from the Ministry of Finance?
Yeah, like Himino's speech, dollar yen bounced by about 25 pips on the back of the speech. I think there was just a little bit of disappointment that there wasn't something a bit more explicit in terms of timing. I wasn't expecting something explicit given, there's still roughly 3 weeks until the actual meeting, and they wouldn't give something strongly explicit in that time frame. But it was hawkish enough for me to keep the pricing as it was, which is roughly 80% probability of a hike in September. So in the fact that the pricing remained the same is an effective endorsement from one of the most senior members of the BoJ, the Deputy Governor, on the current market pricing. So to me, it was still indicative of the BoJ moving in September, and we certainly still expect that. So, the speed is picking up, and Himino's speech, he was using an analogy of a foot on the accelerator in terms of speeding up the pace of tightening, and that when you're below neutral, you can put the foot down, but then external factors, risks, et cetera, could mean you have to adjust the pedal. So he was kind of talking about implying that the pace is picking up, but that there would still be caution going forward from the BoJ in terms of, we shouldn't assume, for example, a linear new pace going forward of every 3 months because they hiked in June and they're hiking again in September. We don't expect a move in December. We do expect one in January 2027. So that still keeps us on track with a kind of a faster pace than what we were used to before. And then that gets you in line with hitting neutral, which is probably 175 to 2 on nominal rates, which we would definitely envisage seeing in 2027.
Very good. And one last story that has been of interest this week, but it was interesting to me that despite the trade deal breaking down between the US and Canada, the CAD sell-off's been quite well contained. Why do you think that's been?
Well, I think firstly the actual tariffs that went effective was just about 5% of Canadian exports into the US. So it was a pretty small amount. Dollar CAD has jumped, but as you said, it is contained. I think the real escalation will come potentially next year. So the retaliatory tariffs on autos and light trucks is effective 1st of January 2027. And as you and I know, and everybody who trades risk in the markets know, you don't trade Trump today on something he's threatening in 3 months' time, because it's all part of the negotiation process. What I would say, though, is that if we don't get any progress and the markets start to really think that is an actual tariff that could be put in place, i.e. 25% up to 50%, and that's on a much bigger portion, I think it's like between 10 and 15%, of exports, then it gets a bit more serious, definitely. And in any way, looking at just relative macro and rate spreads, dollar CAD had overextended to the downside last week on expectations of a deal being done. We've retraced some of that, but based on relative macro, we should already be north of 140. So if things continue to worsen, I would certainly expect us to be north of 140 and potentially, getting up towards the mid 140s if these tariffs are implemented. So we still need to see how that plays out over the next couple of months.
Got it. Thank you. Well, it's great to hear your views as always, Derek. Thank you very much for your time.
Thanks, Simon.
Have a great weekend.
And have a good weekend yourself.
Cheers.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.